All right. What's up, guys? I hope you're doing well. James here from jamesdforsythe.com. And I wanted to come on here and talk a little bit about the basics of Treasury futures, specifically U.S. Treasury futures. It's something that I wasn't sure if there was I wasn't sure of the differences between them and, say, like commodity futures and that sort of thing. So I wanted to come on here and kind of talk a little bit more about the nuances of them and just kind of not only from my own understanding, but also just to get it out there as well. And so CBOT Treasury Futures, CBOT meaning Chicago Board of Trade, right? They're standardized contracts for the purchase and sale of U.S. government notes or bonds for future delivery. In that respect, they are much like other futures. You can get them delivered, even though that's not really what their intent is. Or when most people participate in this market, that is not normally their intent, and we'll get into that a little more in a few minutes. So basically, the contracts are seem to be separated with Treasury benchmark tenors, basically the 2-year, the 5-year, 10-year, and 30-year, right? And then apparently the CME group also offers something called Ultra 10-year notes and Ultra T-bond futures, basically to offer greater precision for trading for both the 10-year and 30-year maturities, right? To kind of, I guess, be more precise on that point of the yield curve and that sort of thing. And what I found, because I wasn't sure what they meant by ultra or what exactly makes them more precise, basically it's how they structure the futures contracts themselves. So they kind of structure them into like baskets in a way, right? And so to take directly from the CME Group website, so each of the bond and note futures contracts has an associated delivery bond basket that defines the range of bonds by maturity that can be delivered by the seller to the buyer in the delivery month, right? So, to talk words, basically what this means, and they have this kind of in little ranges, right? So the 2-year T-note futures, right? So 2-year Treasury note futures, these deliver the basket that we're talking about is between 1 3/4 to 2 years. So it's kind of a small range, right? And then for the 5-year, that's 4 1/6, it's 1/6 to 5 1/4 years. And so it's kind of like thin ranges, and I'll link the actual website itself to the description along with everything else so that you guys can actually see. They actually have a published table on there, right, to where it kind of shows you the deliverable maturities, right? And they do this for 10-year and then ultra 10-year and then T-bond and ultra T-bond, right? And one thing that I noticed for the difference between the T-bond futures and the ultra T-bond futures is for T-bond, the regular ones, that basket is 15 to 25 years, right, of maturity left, or I guess duration left of the bonds. And then ultra T-bond futures are for 25 to 30 years. And so actually it's a much smaller range centered around the actual 30-year tenor, right? And so it seems like they're more precise because they're actually like 30 years or much closer to 30 years in terms of duration left than the other T-bond futures. And then for the 10-year, same concept, but a much shorter range, right? To where the regular T-bond, the regular 10-year note futures are for 6.5 to 10 years, so about a 4.5-year window. And then the ultra version is 9 5/12 for some reason to 10-year. I'll have to look into why exactly these ranges are they seemingly random fractions. I wasn't able to find that yet, so I'll look into that more. But still, just over half a year, so 7 months is basically the range around the 10 years for the ultra version, right? And then there's also the face amount I've noticed in that respect for the actual Treasury futures themselves. It reminds me a lot of options contracts in terms of like the shares and stuff, to where like basically the face amount is $100,000, excluding the 2-year T-notes futures, which is $200,000, right? But I think they're quoted based on per 2,000, for example, for the 2-year ones. And then I don't know if that's the same for, say, each U.S. Treasury futures contracts has a face value at maturity of $100,000, with the exceptions of the 2-year and 3-year U.S. Treasury futures contracts, which have a face value maturity of $200,000, right? And so prices are quoted in points per 2,000 for the 2-year and 30-year contracts, and points per 1,000 for all the other U.S. Treasury futures. So in that respect, it's much like the actual options contracts, to where when you look at like the actual options chain, you're quoted like per share, and then but when you buy a contract, it's 100 times that, because you're doing it for 100 shares, right? And it's the same fraction too. It's just you're doing it points per 1,000, but when you do it, you're doing it for a face value of 100,000. So it's still that 100 multiple, but still. For a little bit of, I guess, a fun fact, I don't know. But in 2018, CBOT U.S. Treasury Futures traded at an average of 4.2 million contracts daily. So it's not a small market. Even if you assume the lower face value, that's what, 420 million? 420 million. And that's not even including the doubling the face value for the ones for the 2-year and 3 years, right? So just kind of ballpark range, $500 million daily in these futures, right? And so another thing, they're also traded, the contracts are on quarterly basis. So it seems like, kind of when the contracts can roll over or whatever it happens to be, it's, you have March, June, September, and December. So the end of each quarter, right? And since I started talking a little bit about rolling over contracts and such, that's pretty much, it seems like now would be a good time to talk about the intent, right? And so in practice, most participants trade U.S. Treasury futures contracts with the intent of either closing out the futures position, so if you buy one, sell it before delivery, right? Or rolling them into longer expiry futures contracts, basically rolling them over into further and further dates, right? So contracts on a longer date, right? Kind of to keep that in mind. And so another thing is what's even the purpose of these to begin with? And what seems to be the purpose for them to me is basically for hedging, right? And since they're U.S. Treasuries, I'd assume basically it's for hedging interest rate risk, right? And so they say they have a diverse mix of customer types, including asset managers, banks, corporate treasurers, hedge funds, insurance companies, mortgage bankers, pension funds, primary dealers, and proprietary traders, right? And just straight from the CME website. And then the vast hedging and speculative activity in U.S. Treasury futures create nearly constant price fluctuations, providing excellent opportunities trading for individual traders in addition to institutional trading accounts, right? And so the fact that they bring up nearly constant price fluctuations and kind of talking about it in the sense of trading, of how advantageous that is for trading, that seems to be, and that would explain the intent of most of the participants in the market, to where they're closing the futures position, right? As we said earlier, basically closing a trade, right? So instead of having the contract reach expiry or receive delivery, you're using it purely for the financialized trading of it, right? And then same with the rolling over, right? But it seems to me maybe the rolling over part would be more applicable for the actual hedging of the interest rates and such throughout time. And another little fact that they cite is since 2000, so I don't know when this webpage was published, but January 2019. So 19 years or so. So since 2000, only about 7% of Treasury futures positions result in physical delivery at expiration, right? So just kind of keeping that in mind of what the true intent of these things are, right? So with that being said, I'm going to leave this one here. Again, the website and everything will be linked so you guys can see the table for yourself, that sort of thing, along with everything else, right? So yeah, I'm going to leave this one here. So I hope you guys have a good night, and I'll see you on the next one.